Number 1. Barcelona. The wage bill collapse. 2021. In August 2021, Barcelona's president Joan Laporta sat in a press conference and confirmed a number that shook European football. The club's total debt was 1.35 billion euros. But the fatal flaw wasn't just the debt. It was the cash flow. Barcelona's wage bill represented 103% of their total income. Every single euro the club generated, plus 3% more, was going directly into the pockets of the players before a single light bulb was turned on at Camp Nou. When the pandemic wiped out stadium revenues, the fragile ecosystem shattered. Barcelona couldn't afford to register Lionel Messi, losing their greatest ever player for free. To avoid outright bankruptcy, the club began activating economic levers, a polite accounting term for selling off future television rights and studio assets for upfront cash. They mortgaged their future to survive the present. Number 2. Borussia Dortmund. The 2005 insolvency. In 2000, Borussia Dortmund became the first German club to float on the stock market. Flush with cash, they went on a massive spending spree, handing out colossal contracts to players like Tomasz Rosicky and Marcio Amoroso to compete with Bayern Munich. By 2005, the money was gone, but the contracts remained. The stock price crashed by 80%. Dortmund's debts hit 120 million euros, and they literally did not have the liquidity to pay their players. They were weeks away from insolvency, which in Germany means automatic demotion to the amateur leagues. They survived only because their stadium investors agreed to slash rent, their creditors agreed to restructure the debt, and ironically, Bayern Munich handed them an emergency €2 million loan just to make payroll. Number 3. Leeds United. The Champions League gamble. 2001 to 2004. This is the textbook example of forecasting failure. In the early 2000s, Leeds United built a spectacular young team, reaching the Champions League semi-final in 2001. To fund it, Chairman Peter Ridsdale took out massive loans against future gate receipts and future television money. The accounting assumption was simple. Leeds would qualify for the Champions League every single year, and that guaranteed revenue would service the debt. Then they missed qualification. Twice. The revenue vanished, but the high-interest debt remained. What followed was a brutal fire sale. Rio Ferdinand, Jonathan Woodgate, and Robbie Keane were sold just to keep the lights on. It wasn't enough. Leeds were relegated in 2004, eventually went into administration in 2007, and spent 16 years exiled from the Premier League. Number 4. Rangers. The tax case and liquidation. 2012. For over a decade, Rangers used a scheme called Employee Benefit Trusts, EBTs, to pay their players. Instead of a standard salary subject to income tax, the club paid into a trust, which then gave the players loans that were never meant to be repaid. It allowed Rangers to offer huge net wages while dodging the gross tax cost. HM Revenue and Customs, HMRC, eventually caught up with them, handing the club a tax bill widely reported at upwards of £49 million. Rangers didn't have the money. In February 2012, they entered administration. By summer, the club's holding company was liquidated. A new company had to be formed to purchase the club's assets, and Rangers were forced to restart their journey in the Scottish Third Division. The pursuit of a tax loophole destroyed one of the most successful institutions in British football. Number 5. Parma. The Parmalat Scandal, 2003 and 2015. In the 1990s, Parma won 2 UEFA Cups, funded by their parent company, the dairy giant Parmalat. But Parmalat's success was built on fraudulent accounting. In 2003, a €14 billion hole was discovered in the company's accounts, Europe's biggest corporate bankruptcy. Parma survived in administration for 3 years before being sold, but the financial rot never truly left. By 2015, the club was completely insolvent, passing through a series of shadowy owners. At one point, the club was sold for exactly €1. Players weren't paid for months. The club couldn't afford hot water in the dressing rooms, and they eventually had to forfeit matches because they couldn't afford to pay the stadium stewards. Parma was declared bankrupt, dissolved, and reformed in Serie D. Number 6. Valencia. The Stadium Debt Trap. 2009. Valencia's crisis is literally carved into the city's skyline. In 2007, the club began building the new Mestalla, a 75,000-seat superstadium. The plan was to fund it by selling the land under their old stadium. Then the 2008 global financial crisis hit, and the Spanish real estate market collapsed. Nobody wanted to buy the old land, leaving Valencia with 2 stadiums, massive bank loans, and nearly €550 million in debt. Construction halted in 2009. The new Mestalla remains an unfinished concrete shell to this day. To service the crushing interest payments on their debt, Valencia spent the next decade being forced to sell off every world-class player they produced. David Villa, David Silva, Juan Mata, just to appease the banks. Number 7. Inter Milan, the Oak Tree Seizure, 2021 to 2024. Inter Milan won the Serie A title in 2021, but behind the scenes, their Chinese owners, Suning, were suffocating. The Chinese government had heavily restricted foreign capital investment, effectively cutting off Suning's ability to fund the club. Desperate for liquidity, Suning took out a €275 million emergency loan from Oak Tree Capital Management, an American distressed debt fund. The interest rate was a punishing 12%, and the club itself was put up as collateral. By May 2024, the loan, plus interest, totaled nearly €395 million. Suning couldn't refinance it. The deadline passed, they defaulted, and Oak Tree legally repossessed the club. The owners lost control of a massive European institution over a single unpaid loan. Number 8. Chelsea, the Abramovich sanctions, 2022. Chelsea's near collapse wasn't caused by bad accounting, but by geopolitics. Following the invasion of Ukraine in 2022, the UK government sanctioned owner Roman Abramovich and froze his assets. Overnight, Chelsea ceased to function as a normal business. Their corporate bank accounts were frozen. They were placed under a strict government license that dictated exactly how much they could spend on travel to away games, capped at £20,000. They couldn't sell new tickets, they couldn't sell merchandise, and they legally could not offer new contracts to their own players. If a buyer hadn't been found swiftly, Chelsea would have run out of cash reserves to pay their wage bill within months, triggering automatic administration. Todd Boehly and Clearlake Capital bought the club in May 2022, narrowly beating the financial clock. Number 9. AC Milan, the Elliott repossession, 2018. When Chinese businessman Li Yonghong bought AC Milan for €740 million in 2017, the numbers didn't make sense. To complete the purchase, Li borrowed €300 million from Elliott Management, an American hedge fund known for aggressive tactics. The interest rates were as high as 11%. Within a year, the financial model fell apart. Li was supposed to inject €32 million into the club as a scheduled repayment to Elliott. The deadline arrived, and the money never appeared. Elliott didn't hesitate, because the loan was secured against the club's holding company. Elliott legally seized AC Milan, wiping out Li Yonghong's entire investment overnight. An iconic football club was acquired by a hedge fund not through a transfer of shares, but through a loan default. Number 10. Everton, the PSR crisis, 2023 to 2026. Everton spent years heavily investing in both the transfer market and the construction of a brand new stadium at Bramley Moor Dock. But the return on the pitch was miserable, and their owner, Farhad Moshiri, eventually stopped writing checks. Because of the Premier League's profitability and sustainability rules, PSR, Everton couldn't hide their massive operating losses. They were hit with multiple points deductions. To keep the construction going and the club afloat, Everton took out hundreds of millions in high-interest loans from complex investment groups, including 777 Partners and the Friedkin Group. The club was bleeding cash in interest payments alone, effectively living month to month on external credit, narrowly avoiding administration solely because creditors knew pushing them into bankruptcy would wipe out the value of the new stadium.